All right, today we're diving into something that's a really smart but, often overlooked part of the investing world, debt mutual funds. If you're looking for a way to grow your money without all that stress from the stock market, you're going to want to stick around for this.
So let me ask you something. Does this sound familiar? You want your savings to actually do something, to grow, but the whole idea of the stock market's wild roller coaster ride, it just makes you a little queasy. You're looking for that sweet spot, right? Growth, but with a whole lot more stability? Well, that's exactly the puzzle we're going to solve today.
Okay, so before we get any further, let's get on the same page. What exactly is a debt mutual fund? Let's break it down.
At its heart, a debt mutual fund is basically a big pool of money. It takes cash from tons of different investors, people just like you and me, and then a professional fund manager invests that big pot of money into things that pay a fixed interest rate. We're talking about things like government bonds or bonds from huge, reliable companies.
Here's probably the simplest way to think about it. When you put your money in a debt fund, you're not buying a tiny piece of a company like you do with stocks. Nope. Instead, you're basically becoming a lender. You and thousands of other people are lending money to big-time borrowers like governments or major corporations, and they promise to pay all of you back with interest.
So we know what they are now, but how do they actually work? What's happening behind the scenes to turn your money into returns? Let's pull back the curtain on that.
The process is actually pretty straightforward. First, a bunch of us investors, we all pool our money together. Then, a professional fund manager, someone who does this for a living, takes over. And here's the crucial part. They don't just put all the eggs in one basket. They build a diverse portfolio of different bonds to spread out the risk. And finally, you make money from the interest those bonds pay out. And sometimes, if the bond's value goes up.
Now, this is really important to get. Debt fund isn't just one thing. It's not a one-size-fits-all kind of deal. Think of it as a huge category, a whole spectrum of different options that are built for totally different goals and timelines.
This table gives you a pretty good idea of the variety, right? For example, let's say you've got some cash you need to keep safe but accessible for just a few days or weeks. Well, a liquid fund is perfect for that. On the other hand, if you want maximum safety for a goal that's a few years away, a gilt fund, which only invests in super safe government securities, might be your best bet. And if you're okay with a little bit more risk to chase some higher returns, you might look at corporate bond funds. See? It's all about matching the right tool to your specific job.
Okay, let's be real. No investment is perfect, right? To make a smart decision, you have to look at both sides of the coin. So let's talk about the good stuff and the stuff you need to watch out for.
The benefits are pretty attractive. You get relatively stable returns, definitely lower risk than you'd find in the stock market. It's usually easy to get your money out when you need it, and there can even be some tax benefits. But we have to talk about the risks. The big one is interest rate risk. Just think about it. If you own a bond that pays 6% interest, and then new bonds come out that pay 7%, your old bond suddenly looks less valuable, right? So its price can drop. Then there's credit risk. It's the small but very real chance that one of the companies you lent money to can't pay it back.
And this, right here, is probably the most important thing to burn into your memory. Yes, they're safer than stocks, but debt funds are not completely risk-free. Understanding that simple fact is absolutely fundamental to being a smart investor. So after all that, we get to the big question. How do you know if a debt fund actually makes sense for your personal financial plan? Let's see if we can figure that out.
So who are these funds really built for? Well, if you describe yourself as a conservative investor, someone who really values stability over shooting for the moon, they could be a perfect fit. They're also fantastic for short-term goals, like say saving for a down payment on a house in the next 2 or 3 years. And finally, if your portfolio is already heavy on high-risk stocks, adding some debt funds can bring some much-needed balance, like an anchor in a storm.
Let's stop talking in abstracts and use a real number. Imagine you have 100,000 rupees ready to invest. What happens next?
An investment like this, put into the right kind of debt fund, isn't about getting rich quick. The whole point is to generate steady, predictable growth over time. The goal is to completely avoid those sharp, stomach-churning swings you see in the stock market. It's about a calmer, more methodical way of building your wealth one step at a time.
So I'll just leave you with this one last thought to chew on. If you picture your investment portfolio as a ship on the big financial ocean, your stocks, they're like the sails. They catch the wind and can push you forward really fast. But every ship, every single one, needs an anchor to keep it steady when the storms hit. So the question is your portfolio missing its anchor?